All right, well, let's go ahead and get started. Let me just go ahead and share my screen. Okay, great. Can everybody see this?
Yeah.
Okay, cool. All right, Dave, are we good to go?
Yeah, I think so.
Okay, cool. Once again, thank you guys. Thanks everybody for joining. So we have these meetups once a month and we're always excited to bring new topics to talk about and see how the current markets are going. And I think it's a good way for everybody to connect with the current market conditions and how are things looking. Based on my experience and also based on what I'm seeing with my other investment groups that I'm involved with. So to quickly go over the agenda today, we'll give a quick introduction about our team. Also, we'll give a current market overview on where things stand on the commercial investing markets. And we'll talk about the type of loan changes and what we're seeing from the commercial loans that we're getting from Fannie Mae and Freddie Mac, how it's impacting loans and what it does to actual pricing, right? And then we'll go into evaluating the deals, right? So I personally have invested in a lot of deals, and I'll share what my personal criteria are. It's different for everybody, but you can get a sense of what the kind of stuff that I'm looking for. And now that I'm, right now that we are actively acquiring properties, what are some of the things that I'm also looking for when doing these acquisitions? Okay. So, a quick disclaimer. This is a group purely for education purposes. I love sharing about all the stuff that I'm learning and all the experience I'm getting from operating apartments. So, the things that we share here, feel free to ask us questions, but it doesn't constitute legal advice. So don't sue me if you listen to something. But yeah. So we're not soliciting or selling anything. And, so we're a group that goes and acquire apartments and other properties out of state. So if you would like to join us on this journey and be notified when, we find a suitable deal that's available, feel free to join our mailing list. Like us more. This group came out from a small 3 to 4 people in the Milpitas library to, something quite sizable. I think we have over 500 members now. So we always love to share more information with more people. So a little bit about who we are. So we're a group of investors, and we invest primarily from out of state. So Dave and I, we are the lead sponsors on some of these deals. So our job is to go out, look for properties, institutional sized properties to acquire, and then we manage them, flip them. And usually our timeline is to sell them after 5 to 6 years. So we look for large size properties. So, for example, if we're buying a large property like $10 million, right? A group of us, anywhere from 30 to 50 or 60 people, would each pitch in a small amount in order to purchase a property as with a down payment. And then so far we have acquired about $35 million worth of apartments in Dallas, Texas, about 350 units. And for these acquisitions, we have raised over $6 million from the groups to go out and buy these large apartments. So a little bit about Link Multifamily. So my name is Tony Lin, and my partner in crime is Mr. Dave Lin. we're not related. We're just we had the same names, but so my
Same
background,
last names.
same last name. So, my background as a software engineer. I'm still, so we're still actively hacking away at cloud computing right now. I was fortunately to be part of two IPOs in the Silicon Valley, but I also have a strong passion for real estate. So I've been investing for quite a while in real estate, 17 years, and in addition to passively investing in other deals, I also we actively lead deals and to sponsor them and to acquire them. So Dave also has a lot of experience on the real estate side. He has a portfolio of rental properties. Also, he has quite a few properties in Austin as well, and that's a pretty red hot area right now, especially with Tesla planning to open a manufacturing plant over there. So Dave, also have diverse investments, not just in apartments, also in hotels, also, startup funding, like small time VC. So yeah, so both of us have pretty good backgrounds and looking to acquire more. So some of the deals that we have purchased in 2018 that we have been focused on managing is our two deals. So one is a 218 unit Class B apartment that was bought for about 23.5 million. 140, and then the second one is 143 unit. It's a Class C in Arlington, Texas. Also both of these are in the Dallas-Fort Worth area. And that one was purchased for $11.7 million. So a quick overview of why we decide to invest in apartments. So, quite a few years back, I was actually looking at, what's the best place to place my money. I'm a very conservative guy. So aside from the money that I have placed into index funds for my retirement funds, I was also looking for a place where I can actively invest my money without having to take on too much risk. Okay, so I went to a lot of meetups in the Bay Area to check out all the different investment options, and in the end came to the conclusion that for my investment profile, which for me not losing money ranks high. So I'm a capital preservation kind of guy, and I'm willing to wait. I'm willing to have less downside, right? So apartments fit that profile extremely well. So, typically we like to acquire single family homes, flip them, sell them for a quick profit, that kind of thing, right? But there's, when you scale up to, from 1, 2, 3 single family homes up to over 100 units in apartments, there are a lot of benefits that we enjoy as a result of that. So, one thing is apartments are extremely downturn resistant because as people lose their homes or lose their expensive apartments, they move down to a working class B, Class C type of properties. And you'll find that apartments are usually full in a downturn. So that was my original investment goals, and it's proving quite true in the current downturn. So across the board, for the properties that we're actively managing, as well as the ones that I have passively invested in, occupancy rates are still in the 90s. The collections have been extremely strong because in the end, everybody needs a place to live and they don't want to lose that. So even through economic downturns, we continue to collect rent really well. So. We also enjoy economy of scale. So when we buy refrigerators, we're buying 100 of them. So we get much better pricing. There's significant tax breaks. There's a reason why Donald Trump invests in real estate, commercial real estate, is because the tax that you pay is minimal. These are long-term capital gains, and then they're basically $15. They're basically 15%. kind of tax rate. Okay, and the cash flow that you get in the near term can be written off against the depreciation that we're able to do. So you pay very little tax on your gains. So another nice thing about apartments is you're able to get yearly cash flow. I mean, the property itself are all very profitable. So you can get a pretty steady cash flow getting paid out to you in quarterly or monthly payments. So, you'll continue to have income. And on top of that, there's also the appreciation aspect. As we improve the property, as we improve the income, we're able to sell the properties for a lot more money. So you're able to get both sides of a coin. So yeah, that's what we really like. And it's really great financing. So when we purchase these properties, if it's a 10 million property, we're not putting up 10 million to buy the property. We're only putting up about $2.5 million. So we're able to get a loan directly from Fannie Mae for up to 80% of the property value. So as a group, we're basically putting up the 20% down payment plus any additional money that we want to renovate the place. So the key here is the less money that you have to invest into a deal, the greater return that you're able to get, right? So if we invest something like 2.5 million, we only need the apartment to increase value by about 2.5 million for us to double the money. We don't need it to go from 10 million to $20 million. So yeah. Okay. So typically, on a Class C property that we take over, the existing management may not have done a very good job, and so that presents an opportunity for us. So we would take these type of units and spend about $2,000 to $3,000 renovation, and we're able to completely update the place and be able to charge a higher rent and collect a lot more income. So this is actually done by our in-house staff. We're actually don't really have to bring up too much outside contractors. Most of our own people can do this. And we're able to get very cheap prices, right? So appliances are only about $200 each when we buy them, because we buy them in bulk. Backsplashes, this faucet is like 20 bucks. Granite countertop, we can get this whole sheet about 7 feet sheet of granite for $99. So when you buy in bulk, and because you're buying in a very large group of apartment owners, we have a lot of buying power, and we're able to, get the prices really low. And that $2,000 to $3,000, $3,000 would include like the new flooring that we put in as well. Cool. So let's talk about where we are now in the current economy. So we have some great news that came out today about the overall unemployment rate. We had a very surprising drop in unemployment. So it reached its peak in April. So it was getting close to like 15%. It dropped in May, and then it dropped again in June. Okay, so I think right now it is at about 11, a little bit above 11% is the unemployment rate. So I like this chart because it shows that while the unemployment have dropped, it's still really high. And the data that this is based off of is taken from the middle of June. And as we all know, the coronavirus cases have really ticked up in the second half of June, and that caused some states to stop their reopening plans. So, especially places like like Texas and Florida and California all have seen very big jumps. And the government are reacting by basically, not expanding the lifting of the restrictions. Okay, so Dallas originally was open up to 75% occupancy in restaurants, bars were open, all this kind of stuff, right? But due to the recent spike, all the bars have closed again, and then restaurants are now reduced down to 50% occupancy. So we expect that this will impact employment in the short term, and this will probably show up in the next unemployment report that we see. So another thing is, right now Americans are still doing pretty well because there was a very large unemployment assistance, being given by the U.S. government. So you get basically $600 extra a week on top of your unemployment check. So that means an unemployed person actually gets paid $2,400 extra a month in what they're collecting. So it's definitely helped, and it's definitely also helped renters being able to continue to pay their rent, right? So this unemployment assistance ends at end of July, though. So it remains to be seen what kind of impact this will have. Currently, Congress are talking about whether or not they want to extend the unemployment assistance, but I don't expect that they'll issue another round of checks for everybody. Okay. So what kind of recovery can we see coming out of COVID, right? So, there's two prevailing camps. One is saying, one by that our president and, other more bullish people like to say is we will see a V-shaped type of recovery. So that's assuming that, our health prevention and this quarantine is done pretty quickly, and economy can try to get back to normal quickly, right? So then we'll see a V shape. But more likely, what we're gonna see is something that looks more like a square root, where after the severe drop, you'll see a very, because the drop was so severe that as we recover, the recovery is pretty significant as well. But there's still shutdowns, and this has incurred some permanent damage on the economy, on the retail side for things, right? We frequently read articles about like places like Neiman Marcus has closed, J. Crew, all these places, 24-hour fitness, all these places are suffering really permanent damage and are closed for good, right? So that part of the jobs is gone and will not be replaced until a while longer, right? So that means that the recovery will probably not be V-shaped, but more likely to be a square root shaped. Okay, so and the reason for the eventual recovery is really that there is going to be pent-up demand. Okay, so people are putting off vehicle purchases. People are putting off things like, vacations and all these kind of things, right? But as you can tell, people can't really stand it. They want to go out. They want to go shopping. They want to get back to the normal spending habits again. So you can put people in quarantine for a while, but eventually they want to return to the normal behavior. So of course, that's also subject to the economic, how much are they actually getting paid, right? It's all about how much income they're actually getting. So, yeah, so right now, don't bet against the US economy because it's always come back. And but the recovery will probably take a little bit longer than we would like. So I shared this slide on our last presentation, okay, but this kind of goes along with what we discussed in the previous slide, is that, the unemployment rate, we enjoy very good unemployment rate in the 3s, okay? And then with COVID, this jumped up to like over 14%, right? And then as the quarantine lifts off, massive amount of people return to work, and you'll see a sharp drop in, unemployment rate, right? But as that happens, retailers are also trying to figure out how much business are they getting after they reopen. And the fact may be that, even after they reopen fully, there's some permanent damage incurred and they're only getting 80% of the previous sales, even after fully staffed, even with everybody shopping, right? So there might actually continue to be another wave of employment adjustment as people let go of some people to account for the reality. And so we kind of expect that the unemployment will probably rise slightly, towards the end of the year, even to next year, and then start, finally dropping again as the economy really recovers from this shock. So, so one thing we look at in terms of commercial investments is cap rates. Okay, so the way we usually value these commercial assets, such as apartments, storage units, trailer parks, or office buildings, we use something that's called a cap rate. Okay, so a cap rate is really a function of your income divided by your purchase price. The income of the assets divided by purchase price, right? And then you get this value called a cap rate. So, cap rate kind of reflects what kind of cash flow, what kind of return would you expect for buying a certain type of property, right? So right now, the average cap rate is about 5.5% for, say, like a Class B unit, a Class B asset. And what that means is, if I'm gonna buy in an area that's returning me about 5 cap, I kind of expect the cash flow to be able to be about 5%. I want to have that kind of return, right? Now, if I'm buying in San Francisco, the cap rate is probably only at 2%. Okay, the return is really low, but in exchange, what you get is relative safety of, we have such a strong job market here. It's not likely to go bad anytime soon. And it's very likely to appreciate. So things like that will, make people accept a lower return in order to get into basically a safer and higher quality asset, right? So, for those of you that are not familiar, cap rate is basically a multiplier that we put in order to use to value an apartment. So if an apartment has an annual income of $1 million, at 5 cap, that means the multiplier is 1/5, which is times 20, right? So $1 million property, $1 million income at 5 cap means this property is worth $20 million. You take the 1 million, multiply it by 20. Okay, so one thing you'll see here is the 10-year treasury, okay, is basically, how much people are making long-term in banks, in terms of loan rates. It's a kind of indicator for a long-term return, right? So right now, what we're seeing is the 10-year treasury is so low. I mean, it is ridiculously low. It's at 0.67%. I mean, just a year or two ago, it was hovering at around 3%, right? So that means people, if you try to invest in 10-year treasury or some kind of safe haven bond, or even your bank payments, you're getting no return. You're getting nothing, and in fact, you're losing money to inflation, right? So people start to look for other type of investments that can garner them a better return. So when you see the commercial properties, multifamily properties can get you a cash on cash return, probably around like 6% or more, people want to invest in those investments instead of putting their money in the bank, right? And right now the gap, so the gap between 10-year treasury and the current cap rate is really large, which makes these kind of commercial investments really attractive. Whereas back in 2006, I mean, if you invest in 10-year treasury, it's about 5%. If you invest in, apartments, it's like 6%, right? There's such a low difference that you might as well just put your money in the bank where it's safe and it's getting you a good return, right? So, but right now returns are so low, so everybody is actually looking for better investment returns. So how has apartment performed after, the COVID, right? So it's actually been very stable. So I think across my investments, all the properties are at least 90 something percent. Okay, so for the past few years, it's been pretty stable at about 95% occupancy. And even with COVID, the occupancy remained pretty high. So across A, B, and C, right now it's at about 95% still. So the basic need is for a place to live, right? So and during this time, people are not moving too much. On our properties, we're seeing pretty good retention rates. So at any given month, you may have 10 to 15 people whose rental leases are expiring. And typically, you get about 50% renewal rate. What we have been seeing the past couple of months is actually a 70 to 80% renewal rate. People during this COVID time, they rather just stay in the same place. They don't want to move. They don't want to go out and look for a new place. So they're staying put. And, at our property, we're actually able to still raise the rent by about $25 on the renewals. And they're happily staying. So that's been really good. So, not really impacted much by COVID at all. So in terms of like new rents, so what the past few years have been really good in terms of rent appreciation, right? So I think, over the past, I would say 3-4 years, the rent increases have been like 5%, 4%, 3%, kind of in that range, right? So, from this chart, you can kind of tell from the beginning of the year, we're still averaging about 2 to 3% rental increase, but definitely it has started to take a hit. So in order to maintain occupancy, the reality is some people are laid off and people don't have the same affordability level as before, okay? So apartments did have to make some changes in terms of like the rent that they are charging, but the drop hasn't been very significant. I mean, it's about, 3 to 4% that we've seen. For our properties, we didn't really have to drop rent, but when needed, we told the office staff that when needed, give them a one-time concession. Okay, so, something you can offer them that first month we'll give you $200 off. Small concessions, right? But that's only in the beginning, and for the rest of the year, we're still charging high rent. So, but this is very interesting to look, okay, and also very interesting to keep in mind, because a lot of these deals were underwritten, were basically projected using the concept that, hey, the rent are gonna continue to increase at a 3% rate every year, okay? That's just not the case anymore right now, at least not during the short term that we can see. So if you are evaluating deals on whether you want to invest in or not, you should look for people who are conservatively estimating that the rent growth to be 0 or 1% for the next 2 years. Okay, that's way more realistic. I mean, you're not gonna expect 3% rent growth for all the years going after, right? So the rent growth projection should be conservative, okay? 0 to 1%, I would say would be fairly good, okay? Some people, may even be more conservative and go like -1% for the next year and 0% for the year after that. But I would be very conservative in, in how you're evaluating these deals. Any questions so far? So if you have any questions, feel free to leave them in the chat channel. As we go through the slides, I'll be happy to answer any of them, and I'd like to keep this interactive. So yeah, feel free to ask questions if you have any. Okay. No? Okay, I'll keep going then. So, I go to a lot of these, seminars. I mean, not seminars, but right now all the groups are getting together, sharing data across the United States. Getting an idea of what are the rental trends, how are we collecting, where are we not getting paid. So some of the weakest areas that we've seen are actually, in Maryland. So this is the data for May, for the entire month of May, okay? So how many people, paid? So you can see at the lower point, okay, it's about 11% drop of, people who did not pay. Okay, so some of the worst hit areas are Baltimore, New Orleans, Las Vegas. Las Vegas is easy to understand. They're just not many visitors, not many jobs, right? Seattle, surprisingly, was actually also saw a rent decline. But this is, you see Seattle and you see LA, and you actually see the percent of people who are delinquent and not willing to pay tick up in California as well. And this is due to, California being very pro tenant and anti landlords, if you will. So if you look at all the rulings that have been coming out lately, for example, I think San Francisco and California are both doing legislations where you cannot kick out the renters if they don't. So a lot of these things, are. So for example, I have a friend that has a property in Dublin, right? That lady who has a great job has not been paying since March, and you can't evict her. There's nothing you can do. And then so if the current eviction rules hold, she can probably the tenant can probably live there for like until next year, okay? And then after next year, you had to apply for eviction, and then after eviction, she probably won't leave, and then it could be a year and a half before you kick her out. So yeah, it's one of those things. So that's why you'll actually see places like Seattle, LA, even in the Bay Area, where people are definitely have the money, but they're just protesting it. They're just protesting the rent. We don't really see that in Texas. Texas is a kind of state where, if you don't pay, you don't play. You'll be out in 3 months. I'm sorry, you'll be out in 3 weeks if you don't pay, right? So currently there's an eviction memorandum, but that also expires at the end of this month, and evictions will start. So there's a lot of people that actually is part of the reason why people are still so much paying on time. So aside from apartments, I'm also, I'm personally very interested in student housing. I always want to kind of see how student housing are doing. And at the beginning of the year, when the COVID first started, there was a big worry from the industry that with so many universities going to online schooling, there could be a big drop off in the number of people that sign leases, right? So why would you sign a 12-month lease when the fall session is not, it's going to be all online? So, but so far, there's a slight decrease compared to last year. Doesn't look like the sky's falling, but, it looks okay so far, right? I do know that there are some universities such as Cal State, which, the Cal States have all said that they're going to move to online classrooms for fall. UC is still kind of up in the air, right? It's a hard thing to call because of this COVID resurgence that we have seen in the last few weeks. So for example, even for my daughter, she's going to high school next year. And, even then the Fremont School District is not totally sure whether they want to open it back up or not. So there's still a very good chance that even for like high school students, their fall semester may actually be online. So if that sentiment continues, you might actually see people break leases from these universities. And that's a real impact that you want to watch out for. So, as soon as I say that the instruction plans for fall 2020 is solidifying, most of them are going to be in person. Based on the last 2 weeks, the percentage of university that's going to be in person may change drastically as well, right? So we're keeping a very close eye on that. So what we typically find is classes that are big auditorium style ones, like Chem 101, those kind of very large classes, those tend to be held online. And then for the ones that are, smaller class sizes where people can be more spread out, universities would actually still do in person for those, right? So the behavior is different. Each school treats it differently. But so far, there's only 4% of the university that said that they're going to go all remote. 11% is still deciding, but majority of them seems to indicate that they're still going to be in-person instructions. So there's still some universities that's having trouble leasing up, getting renters. So you can see some of the universities here. So some of them compared to the previous year are up to like 10% below the pace, right? And usually this is the season that you're leasing up, and you want, for student housing type of deals, you want to be pretty much completely all leased out at least by August. If you miss this window to be completely full by the time the school starts, not many students come looking for apartments after school starts. So it's a very different industry where you start leasing for next year in October. So you would start leasing for 2021 fall in October of this year. You start offering some discounts, right? And then you just want to be completely done in the summer and get ready for the fall session. Okay. So, a look across the different industries, how are we doing? So CMBS is basically a loan that's a higher risk loan. They're willing to give out loans to people, to corporations that are not doesn't have as strong of a business plan. Okay, so, and from there, so this is basically the number of loans that are in default that is going with the CMBS program, right? So some of the major places that we get commercial loans from is Fannie Mae, Freddie Mac, CMBS, and then finally to some local banks such as Wells Fargo, Chase, etc. Right? But on the agency who are Fannie Mae and Freddie Mac, they saw very little delinquency. They saw very little non-payment. So on the apartment side, they only saw about like 2% delinquency to 3%. So on the CMBS side, it's much, much worse. So as you can kind of see, breaking down by industries, industrial and manufacturing, okay, have fared pretty well. These tend to be, businesses that have more cash, have longer running deals. They're not relying on monthly cash flow to keep them afloat, right? As you can imagine, hotels are just suffering, right? They have nobody traveling. There's nobody coming in. So So lodging, the default rate is actually up to 20%, which is really, really high, okay? Retail, as you can imagine, retail is also doing pretty bad. There's a bunch of stores closing, not renewing their leases, and they're not able to pay, okay? Here's multifamily. Multifamily is about 4% for CMBS. Like I said, most established apartments don't use CMBS. We use Fannie Mae and Freddie Mac. Yeah. So office buildings, okay, office building is an interesting one. So office for businesses are actually, they're pretty well funded. They do multi-year leases, and once again, they don't rely on the monthly cash flow to pay for their operation. They have some funds in the bank that they're running the business with. So these tend to be more stable. However, with this COVID, we're seeing a very large uptick in the number of people who want to work remotely, right? Most of you on this call is probably working remotely. And that means the demand for office space is way down. There could be some small companies that's planning to move to a larger space. Well, they don't have to do that now because half of their employees are working from home, right? So there's a certain amount of risk in office that is not showing up right now, but it may come. And we do expect that to come. Okay. Moving on. Just make sure I have my comments. Okay, cool. So talking about loans. So one of the biggest thing about getting a commercial property is loans. This is like 75 to 80% of where the money is coming from. So you want to make sure that you're able to get all the money you need. The loan broker should be your best friend. You should have a great history with Fannie Mae and Freddie Mac because they are literally the biggest investors in these deals. You're only putting up 20% of the money. They're putting up 80%. Okay, so they're very, very careful about where they put their money. So when this, but typically multifamily has been a very safe investment for Fannie Mae and Freddie Mac. During the 07-08 downturn, when Fannie Mae was losing their pants over the residential loans, their commercial apartment loans were actually doing extremely well. So well that they were still making a profit on the multifamily side, and they're using that money to offset what their losses in the single family residential side. And this is why, compared to like all the different things that you can invest in, right? So things like office space, retail, even in industrial buildings, right? Over there, you can only borrow up to 60% of the purchase price, or maybe at most 70%, right? And that's a function of risk that Fannie Mae think it's taking on. But for apartments, Fannie Mae has so much confidence in it that they loan up to 80%. So because it has been such a stable asset class for them. But of course, when COVID hits, Fannie Mae does not know, how big of an impact this will be, right? So just like when in the beginning, we were actually preparing for a 40% drop in rent collection, Fannie Mae was also making that kind of preparations. But in the end, we did not see a 40% drop in rent collection. In fact, we only saw maybe a 6% drop in rent collection, maybe even less than that. So some properties saw no drop, okay? So, when Fannie Mae was scared in the beginning for any new loans that they were giving out, they were actually making a big requirement, okay? So they were saying that, hey, if you want this loan, I'm feeling scared. What I need you to do is you need to put up 12 months of mortgage, property tax, insurance, and any repairs that you may need ahead of time. So you would need to bring all these money to the table when you're buying the property. And then they're going to put it away in what's called a lockbox. You can't touch it. The money does not belong to you. You cannot touch it. Fannie Mae will maintain that lockbox. Okay. And they will hold on to that money. You can't do anything with that money. They will only release it after 12 months. After 12 months, they wait for another quarter to see that you're able to have a pretty good income. So the DSCR stands for debt service coverage ratio. So what that means is if your loan payment a month is $100,000, they want to see that you're bringing in at least $125,000 in income, okay, to be able to cover the debt. So what this means is, on a $20 million deal, you need to bring an extra $1.4 million to buy the property, okay? And because you're now using more money for the same return, your overall return drops because you're actually bringing more money to the deal. So this means that if you're bringing an extra 1.4 million, that's doing nothing for a year, for doing nothing for 5 months, your 5-year return will actually end up dropping 14%, which is quite significant, okay? So when we buy properties, we only buy properties when we're able to see that we can achieve a pretty confident level of returns, okay? So if we cannot get that return, if our overall return drops by 14%, I'm not buying that asset. So what this forces is, this forces the seller to lower the price, to compensate for this, okay? So in order to make up for this 14% drop in 5-year return, the purchase price need to be lower by 4% in order to compensate. Okay, so that's kind of what we're seeing in the market right now. So if you ask me what kind of discounts that we're seeing in the market, right now we're seeing about a 5% discount. Okay, so unfortunately the sky didn't fall. there wasn't like a big opportunity to buy distressed assets or anything like that, because as you can see, apartments actually continue to have high occupancy and very good collections, almost as if nothing has happened, right? So not many distressed properties. And so, the sellers are not budging much on price because they're able to continue to have good operations. So a couple months into this COVID crisis, Fannie Mae looked at its overall loan payments and saw that, hey, apartments are actually doing really well. Only 2% delinquency, right? So which is really low, which is really safe, right? So they felt much safer and loosened up the requirements for getting a loan. So you no longer have to escrow your tax or insurance or repair reserves, okay? And instead of a 12-month mortgage escrow, they're only requiring 9 months now, okay? So this really significantly lowers the amount of, I made a typo here, but basically on a $20 million deal, instead of having to bring an extra 1.4 million, you now only have to bring an extra $900,000. Okay, so this drop, instead of dropping the overall return by 14%, this drops it by just 9%. Okay, so the prices would then need to be discounted by about 3% instead of 5% in order to compensate. So that's kind of what we're seeing in the market. Discounts around 3 to 5%, not as significant as we had hoped. So we're still watching the market very carefully, and we're still ready to jump if a opportunity presents itself. But it has to be priced pretty well to account for some of the market risk that we're taking on here. Any questions on this? Cool.
Actually, Tony, I had a question. Couldn't you, I guess, use the escrows when they're released for like repairs and stuff, and so that probably wouldn't hurt too much the returns?
Right. So you can. However, so things like property tax, insurance, and repairs, these are all part of your operation expense, and they're usually covered by your monthly rental income. So it's not something that you would need to raise extra money for. This, so at the beginning of the month, you're collecting anywhere from 100 to $200,000 in rental income, and that pays for your property tax, that pays for your insurance, that pays for um, your mortgage, right?
Right. Right.
So
Yeah, I guess by repairs I meant like any like upgrades or something to like the units.
yeah, so that's a separate field. Okay, so usually there's two reserves that they will require you to do. One is called capital improvement reserve,
Mhm.
and the second one is replacement repair reserves. So these two are different. So the capital improvement that you're talking about
Mhm.
is is basically to renovate the units, right?
Mhm.
Whereas the replacement reserve is probably, you know, the lender is calculating $300 per unit that you had to put up to cover just a normal everyday, things breaking down. You had to fix the pipes, you had to fix the electricity, etc. That kind of thing.
Okay.
Yeah. So normally they will require both a repair replacement escrow as well as your capital improvement escrow, right? However, you're able to make claims against that. So for example, if I spent $5,000 this month in repairs and maintenance, I just send a copy of those invoices to the lender, and he would reimburse me the money back from the escrow right away. Okay, so you're never really short of that money, right? But when they're locked away, you can't claim against it. You can't actually say, hey, lender, can you give me those money back? They're not going to release it until a year later, right? And that really hurts. That means your cash balance is dropping, um, and you're not getting reimbursed from this. But yeah, so it hurts. Okay. So going forward, how do you evaluate deals, right? So I started off investing in apartments and other type of commercial assets as a passive investor. So a passive investor is basically somebody who just brings money to help acquire the deal and get a partial interest in the ownership, right? So if you invest $100,000, for example, then you get your ratio in cash flow and that type of, and finally, when we sell the property, your share of the profit, right? So I have invested in over 3,000 doors. So, you know, these are hard-earned money. So I'm very careful when I evaluate deal sponsors. And, I've looked at so many deals that um, I have a pretty good idea of what I'm looking for. Um, so, even though I'm actively acquiring and leading deals right now, I still, when I acquire deals, I look at it from a passive investor point of view, because I come from a passive background. So if I want to invest in this deal, what would I want to see? What kind of, um, what would make me want to invest in this deal? Okay, so I look at it from a, investor point of view. So when I'm evaluating deals from other people, these are some of the things that I'm looking for. Okay, so the first and foremost for me is always who is running this deal, who is leading this deal. Okay, the deal sponsors to me are the single most important aspect. Okay, so it's okay if the person is new, and it's great if a person is experienced. But for me, very importantly is this person able to handle changes in the environment, right? So there's some syndications where the sponsors have gone through the downturn of '07, '08. Okay, there's some people that own properties that ran into a lot of issues, and they learned how to address those issues, right? Um, so being able to fix things when things are bad is extremely important quality for me. I mean, when things are going well, everybody can run an apartment for a profit. Is what happens if it's not going well? Are you able to handle it and fix it and bring it back to normal? Is the most important attribute for me, right? Just like in the dot-com days, anybody can invest in any stock and pick and be a winner, right? But you know, when the things hit the fan is when you find out who's really who are the ones that you want to be managing your asset. So secondly, I look for integrity. Okay, so me personally, I don't like people who talk about themselves or how great they are too much. I try to look for somebody who's more humble and who's actually, I can tell, is very hardworking, right? And one of the ways that you check for somebody's integrity is by talking to other people who have invested with them before. So one of the reasons I set up this meetup group is so I can meet with fellow investors and figure out, hey, have you invested with this person before? What was he like? Does he communicate well? Does he tell you something and then you find out it's completely different? Does he lie? Does he exaggerate the truth? So, I think all of us are pretty seasoned experience. We know that, hey, not all investments go well, right? I could have a rental property in Dublin that doesn't get paid, and that's normal. But the sponsor have to let us know, okay? Let us know what's going on. Don't hide it. Is very important for me. Energy level. Believe it or not, I actually rank this really, really high. I want somebody with a high level of energy that wants to get things done, that is hungry, that is motivated, right? So what I mean also on this is, there are people out there that raises money for other people's project, but they're not really involved in the project anymore after that, right? Um, they're just raising money, right? So I want somebody who's energetic, who's actually actively involved in his own deals, and care about his reputation and actually working really hard. Okay, so energy level for me, I think that's a key attribute I look for. Okay. And also something very important is business network. How well connected is this person in his field, right? So I don't want to just see that he's doing good in performance, because what I learned from experience is the more people you know, the more people you have access to. It could be other people who are running apartments, other apartment owners. It could be loan agents. It could be insurance agents. It could be people who do your utility, okay, who negotiate the utility rates. The more connected somebody is, the more option he has when things start going bad. So, a case in point, right? Believe it or not, one of the problems that we're currently facing is we're not able to buy enough refrigerators. During the shutdown, there's a lot of refrigerators from China, and these appliances are just not making it overseas. So these things are in short supply. But if you have enough connections, you can reach out to multiple vendors, even ask your other friends in the business, hey, where did you find a new source for appliances, right? And this network is invaluable in getting yourself out of trouble. So a well-connected person who's always engaging with people in the industry is actually a much safer bet. Okay. So other than the sponsors, these are the other kind of stuff that I look for. Okay. If I'm investing in an apartment, I'm looking at that market. Okay. How, because one thing you can't change is location, right? So I want to make sure that any place I invest in is having a good population growth, okay? It is having a good job growth. And then the people are able to afford the houses there. So I want to see a good income to rent ratio. So there's a lot of deals that could be out saying, because they can't really compete in like the primary markets such as San Jose, San Francisco, Dallas, Texas, Austin. So they end up going to like the neighboring cities. It's kind of like, you're going to Tracy to invest somewhere because the Bay Area is too expensive, right? But those remote places carry a lot more risk. So I want in a downturn, those people lose jobs in the remote places, lose jobs the quicker. And you don't have a large enough population pool for you to rent the place back out again, right? So that's why I like to stay in what we call primary markets. Okay, so okay. So after evaluating the market, then I kind of look at, what type of investment is it? Okay, so there's, I didn't finish the slide here, but there's basically 3 type of investments that you can do. One is just pure cash flow, right? So imagine you bought a Class A that was just finished 5 years ago. There's basically nothing to fix, nothing to update. You're just getting a steady return, okay? But that's all you're getting. You're only getting a cash flow payout. There's not really any appreciation because you're not improving the property, right? So on the other end of a spectrum would be something like a flip, okay? You're buying a really rundown apartment that has a lot of things that need to be repaired. You buy it, you spend a large amount of money to renovate it, hoping that you can turn it for a big profit, right? But because the rental income is so low, Fannie Mae and Freddie Mac, they're not gonna give you a loan. Okay, so you're gonna have to go for some much higher rate local bank loan, or get a bridge financing, very temporary stuff, right? So those carry higher risk, higher reward. But my investment philosophy is around hybrid deals. So hybrid deals are deals that are stable, our apartments are stable, that's already cash flowing, but it has some things that you can improve. So similar to the pictures that I've shown, it's a stable property, very good occupancy, already collecting and very profitable. But I just need to go in there, do some minor renovation, and I'm already able to increase a lot of value that way. Okay, so I don't want to be tearing up walls and doing big renovations. I want to do small, easy renovations, and this way we can change a property quicker and then be able to sell it quicker as well. Okay. Oh, this is another thing on the sponsors. The sponsors must have liquidity and skin in the game. What I mean by this is, well, first of all, the people that do deals, I want them to have money in the deal themselves. So if it is like a $10 million deal, the sponsor should at least put 100 grand or 200 grand into the deal themselves. Okay, so when the sponsors have money tied up in there, they're stressed about it. They're stressed about their own money, right? And they will work much harder because it affects their income as well, right? Their money is in there. Second of all, sponsors, a sponsor group who have a good amount of liquidity themselves, meaning that they already have money themselves, that's, I feel much safer about that. Because if the market goes sour and, the apartment goes negative, etc., sponsors who have money themselves, because they want to protect their reputation, they will start using their own money to prop up the deal. Okay, so they would actually do personal. They would spend their own money to make sure the apartment continues operating until which point the market comes back, right? So, to me, that's another safety net, right? And people with that kind of liquidity really care about their reputation, about ability to do future deals. So those tend to be much better sponsors. Okay. I don't like new constructions, and I don't really like senior housing. No, senior housing. Okay, so I'll give you a reason for that. So a typical new construction deal goes like this. Okay, you invest your money, and it takes 2 to 3 years to get all the permits, fight with all the contractors, and finally get the place built maybe in 3 years, right? During 3 years, there's no cash flow coming back to you. So your risk is actually a little high, okay? And then also, these permits and these kind of stuff, these contractors who just stop working, it could drag on for a long time, okay? So, if they projected 1 to 2 years of finished building, I would project 3 to 4 years, just to be safe. So after they finish construction, then they go into what's called a lease up phase, right? So they had to go from 0% occupancy to close to 100% occupancy. Okay, this way there's good revenue to show in the books, and then they're able to sell it to the next buyer. Because banks make loans based on how much money have you made in the past few months, right? Or even up to a year. So if your apartment's finished but it's completely vacant, you're not going to be able to get a loan. Okay, so new construction is very risky, but when it finishes and works out great, typically these have really attractive returns, right? So you just have to bear in mind the kind of risk that you're taking for the kind of returns that you're getting. So like I said, this is my personal investment profile. It's never a one size fit all. Everybody have different risk tolerances. I'm a very conservative type of person in my investments. So yeah, my number one goal is not to lose money. Okay. So senior housing, hospice care, those kind of stuff. These are also very popular nowadays, but they carry very large risk. As you can see, right now, COVID is causing a lot of problems in nursing homes. Senior housing is a lot of times also dependent on the ability for your children to pay for this care, long-term care, right? So senior housing goes anywhere from like $2,000 a month to $3,000 a month if you need like some special care, and then up to $5,000 a month if you have some serious medical conditions, right? You need more intensive care. So if we're in a bad economy, unfortunately, the kids may not always be able to continue paying for their parents' bills. And, so during bad economies, you actually may see a lot more vacancies. And, so what, the kind of asset class I was going for is in a bad economy, it's actually full. and that's apartments. So I know that I can write out the downturn. Okay. Also, in terms of market I pick, I want to be a primary, so large metro, without natural disasters. Okay, so you know, so places like Florida, it's doing pretty good, but one thing that people don't really talk about is how expensive the insurance rate is. Okay, so for a large multifamily, you know, your insurance coverage, the most expensive aspect of that is probably your roof insurance. Um, so in Texas, you know, sometimes we get hail. In Florida, in Louisiana, in Houston, you get hurricanes. So you can imagine, you know, how much that costs insurance. And what we're seeing nowadays is in the last couple of years, you know, we had a large fire in California, right? We had large hurricanes that impacted our coasts. So, you know, whether you believe in global warming or not, the insurance companies are pricing this risk into it. And, you know, based on what they had to pay out recently, they sincerely believe that it's going to happen. So a lot of companies are actually exiting the insurance coverage arena, because they don't feel they can get good returns on it. So, you know, take Dallas for example. It went from like about 50 carriers that covers that has different insurance coverage for the Dallas area to like just a handful now. Okay, the smaller companies just cannot take the risk. So same thing goes for Florida. When one of these storm hits, insurance renews on an annual basis. After the insurance is done paying out all those people, guess what's going to happen to your insurance rate? So a deal that you bought that you thought makes sense because you assume the loan is going to stay relatively flat, you might be in for a big surprise when insurance company had to do a big payout for certain things. So that's kind of you know, my investment criteria. So I didn't, you know, so there's more stuff that I want to cover. It wasn't in the slides, but so now, you know, when you're looking at deals and then when you're thinking of like, what are the parameters I want to consider, right, before I invest in this deal? One of the things that I would definitely look at is what are they assuming that the rent growth is going to be? Okay, so if you're assuming that the rents are still going to grow 2 to 3%, I'm going to run away because that guy either doesn't know the market or is way too optimistic in order to make the numbers work, right? Second thing I will look at is what are they projecting to be the economic vacancy? Okay, so economic vacancy doesn't just cover vacancy. It covers bad debt. It covers people who are delinquent on their debt. It covers, you know, you're not able to charge the market rent for your for your apartment, for example. It covers a lot more than just physical vacancy, right? So I would want to see, you know, because we're in a COVID environment, I would want to see that people project a much more conservative number in economic vacancy. Okay, so in the good times, people are projecting about 5% physical vacancy and 10% economic vacancy. Okay, if I'm looking at deals right now, I probably would project about 12% economic vacancy, you know, to be safe. For this year and probably the next one. Okay, so just to be a little bit more conservative and know that, you know, it won't be as good as you think, right? Another thing I would probably look at is basically what price they think they can sell at. Okay, so you buy at a certain cap rate, which is a multiplier. And do you expect the multiplier to be better when you sell, or do you expect it to be worse, right? So if we go all the way back to the chart of the cap rate trend. Okay, so as you can see, this is the cap rate trend, okay? So if you take a look, so single family homes, the valuation of single family homes basically goes up and down depending on how much your neighbor sold for, right? You have no real control over that. It's just the market sentiment, okay? Whereas apartments, we trade based on this, this cap rate, okay? This multiplier that we use. And you can see that, you know, through all the years of up and down market conditions, the multiplier that gets used for apartments remains pretty stable. Really have remained really stable, around 5-6%. Okay, so the valuation becomes completely based on performance. Is this apartment very profitable? Yes, then it's worth more. If this apartment not very profitable, no, then it's not worth very much, right? So so one job is, do you expect that 5 years later, is this cap rate gonna stay the same? Or do you expect it to get worse, meaning the multiplier is not as good? Okay, so investors, sponsors who are conservative will project that the multiplier will be worse when they sell, meaning that they will project that the market condition will actually be slightly worse than the market condition that they bought at. Okay, this is being conservative. An aggressive person would keep the cap rate the same. Okay, so they're gonna say, I'm buying at 5.5, I'm gonna sell at 5.5. Okay, so unless you have a crystal ball, you're not gonna be able to guarantee that 5 years later the market condition is gonna be the same as today, right? So you know what I typically do when I underwrite deals is I assume that 5 years later, if I bought at 5.5, I'm probably going to sell at 10% worse, okay, which would then be about 6% cap rate, right? So I don't want to assume that the future is going to be just as good as now, right? I always assume that the future is going to be a little worse. Now, if it stayed the same, hey, we made money, right? We actually made money because it wasn't as bad as I thought, right? If you know, if at the worst it falls to where my projection was, then you know we already planned for it, right? If it's the same, then we made money, right? If it did better, then we made a lot of money. Okay, so but overall, project for, you know, the lower end of things, and you know you won't get caught. Okay, and yeah, so you know, my investment philosophy, I was just kind of talking about this. Basically, I look for continuous cash flow. I expect that, you know, the deals I invest in should at least have 6% cash flow year over year. So every year I should be getting about 6% money back. And then when we sell the property, I want to see at least a 12% return on a yearly basis for the profit that we get. And, you know, that's kind of like the minimum that I would consider a deal. Okay, cool. And that's the presentation I have today. Yeah, feel free to ask if you have any questions.
I've got one. How did you guys kind of find a partner or boots on the ground in your target market?
Okay, so you know, we're fortunate because we have a pretty large network of people in this industry. So on the 2 deals that I showed you, we are actually a group of 4 people. Okay, so this is me. Okay, this is one of my partners, Helen. Dave is here somewhere. Oh, Dave is here. Okay, and you know, and these are 2 of our partners. This is Wind, and Ken is hiding somewhere. I can't find him. But oh, Ken is right here. So this is Ken and Wind, and they live in Dallas. So we met them through one of the apartment conferences. And so there's a very interesting story about Ken and Wind. So Wind actually, so both of them are from Hong Kong, and they moved to Dallas about 2009 timeframe. And so Wind was actually looking at the Dallas properties and go like, hey, these houses are only $60,000 each, and I can charge $700 in rent. Okay, that's like more than 1%, right? So she went, and through the years, she purchased over 70 of those properties. So she bought 72 single family homes, and she was managing them all herself. And then, of course, that was very, very tiring. It's a lot of tax returns to keep track of. It is a lot of repairs and stuff, right? So later on, they realized that, hey, we can just, instead of managing 70 single family homes, why don't I just acquire 100 unit apartment? I only had to worry about one, and I get all the benefit of scale and all that kind of stuff, right? So Ken and Win, you know, they have purchased, I think 11 properties so far, and they have already, you know, gone full cycle on 4 of them, meaning that they sold them after holding them for a number of years, and you know, they bought it pretty early, so they had really good returns. I think the average returns for those were like about 40 to 50% on an annual basis. But you know, it's, you know, you can't expect that to happen every time, but we're still doing pretty good. So yeah, you know, you do meet these people. You meet people with a similar mindset at conferences, at meetups like this, and just generally, you know, chatting with people, right? So every year there are some multifamily events, either in Dallas or in across the nation. There's a national multifamily housing agency that hold events either in California or Florida, right? They kind of alternate every single year. So those events are good to go to. But you know, once you're in this community of people, you quickly get to know a lot of people. So I think I'm familiar with just about everybody that acquire multifamily, and you know, so we fight with each other on deals, but after one of us win the deal, we're all the best friends. We're all talking about like, hey, you know, where can you, which roofer have you used? You know, hey, how did you get the fences painted for so cheap? You know, so we all share information. We're a big network of, you know, owners, and we help out each other, right? But yeah.
Thank you. That was really helpful.
Yeah. And by the way, you know, I once in a while, I do go out and, you know, I just walk properties in the Bay Area. I just go and check out apartments, right? Not ones for sale, but I just go and walk the apartments. Because by walking apartment, you can quickly, I wouldn't say quickly, because I walked over 50 apartments in the Bay Area just for fun. But you'll start to be able to spot things like, hey, that roof looks older, it's deteriorating, right? Versus one that are brand new. You're able to see things like, you know, the drainage for this grassy area is going to be a problem, okay? Or you'll see things like, hey, there must be something that came up the sewer pipe before, because there's like paper tissue around the sewer clean out. So you know that this apartment probably has a plumbing issue, a sewer issue that you're going to have to go in and fix, right? So the more experience that you get walking these properties, looking at, you know, different setups, you don't have to be out of state to look at those apartments. We have these apartments right here. So once you gain the ability to evaluate apartments and, you know, get practice on how much these replacements will cost, and then you're able to make very informed decisions when acquiring properties, right? So I, you know, on two of my last outings, I actually had a few people come with me to walk these apartments, and they got to meet each other. And I think that's another good way to find people who are motivated, and maybe find another partner that who want to work with you, right? So, but I think what your question was very good. You always want to have some boots on the ground. We don't invest in California. California is just a terrible place to invest for real estate. But working remotely, you do want to have a partner or somebody you trust that can help you handle the stuff, right? So in another group that I invest with, they have one of their 4 partners actually live permanently in Dallas, and he goes and check out stuff when needed. Okay. So let me just go through some of the comments. So how long have you been investing in multifamily apartments? So I've been investing in the past 5 years. And so I've been investing in the past 5 years, about 10 properties. Yeah, like I said, over 3,000 doors. They're all doing really well. I also invest in self-storage in out of state in Wisconsin. I also invested in new construction project. That's why, I have personal experience that thing takes a long time. And also I I'm a part owner in a plumbing business in LA. So, I try to vary my investments so that I know how each industry performs, right? So in these multifamily, some of them are really new apartments. Some of them were like the complete teardowns and rebuilt, like I mentioned. And each one have their different characteristics. And for me, I was really interested in apartments, so I thought the best way for me to learn is to invest in them and and watch how the business is executed and what kind of gotchas are there, right? So by watching it real time. Okay. Hope that answered your question, Ramil. Okay. So next question. Are you concerned about having too many properties in the same market? For example, Dallas area. Would you consider other areas to reduce risk? Yes, absolutely. So, when I was evaluating different markets, there are a few markets were actually potentials, right? So one of the, 3 of the best markets, actually a few of the best markets to invest was Phoenix, Arizona, Atlanta, Georgia, Fort Lauderdale in Florida, and also places, up and coming places like Indianapolis, right? So, but if you kind of run the comparison, okay, of what makes these market good, why are they going up, okay, you kind of look at their growth rate. So the Dallas area had over 100,000 people migrating to Dallas a year. That's equivalent of a San Mateo moving to Dallas every single year. They have such an influx, and they're so centrally located with a huge airport, very strong logistics, right? So I can see why people continue to come and why we're able to continue to raise rent, right? As a result, there's also a lot of big companies moving to Texas, right? Now, Atlanta, Georgia has, also good, strong rent growth. Phoenix, a lot of it is actually California investors. The funny thing about Phoenix is it's not that far. So California investors only had to fly about an hour away to go check on the property. Dallas is like 3 hours. Florida is, 6 hours, but mostly it's East Coast people investing in Florida. For me, when comparing these markets, I did not see that their population growth and job growth was that much stronger than Dallas. Okay, and the prices there were just as expensive, if not even more competitive. Okay, so generally, you want to become very established in one market before you go out and explore other markets. The reason is it's always about scale, right? If I'm an owner of 5 to 6 properties in a certain area, I'm well known, brokers know me, I'm able to get a lot of insider deal flow. I'm able to leverage for better pricing on electricity, on all those other stuff, right? So, you know, you want to be good in this area because you could be, you know, you don't want to divert your attention too much between 2 different areas as well. So if I have one in Memphis, one in Atlanta, one in Dallas, one in Las Vegas, where am I flying to go visit, right? So it's much better to be concentrated. And when you grow so big and you're actually looking into other cities, your team of partners probably have grown by that time as well. You probably have hired somebody to look for deals for you in the full time, and you're able to spend your areas on multiple geographies, right? But from the people I talk to, the successful ones are the ones that stick to an area and become expert in that area. And as long as you choose a very diversified job market, a very healthy growing, and there's a potential for continued growth, you'll be fine in, you know, even if it's just one market. So hope that answers your question. So, but, you know, because we also partner, so I also partner with another group, Boris and Oshi. So we go out and we are actually evaluating much larger assets that we can acquire together. So these are like 500 unit deals, very large. And the other group that I partnered with, they had like about 8 deals under their belt and over close to 2,000 units. So yeah, so they're very established. And then so we're actually branching out, looking at places like Indianapolis and you know, other places. We're ready to expand from that point as well. Okay. Next question. So you mentioned that you started off as a passive investor. When did you shift to an active role and why? Do you still play the passive investor role in other deals? Okay, excellent question. So, so I started off investing in passive, but almost immediately I got very interested in the business, right? So I'm a numbers guy. I'm a computer programmer. I like looking at deals, and I like the fact that multifamily apartments is a business, is literally a business where you look at the profit and loss. Everything is based on performance, right? So the property valuation, everything is based on performance. And you're actually able to, like a business, have a reasonable projection about how profitable, where's the market going, you know, what can I expect to do in order to increase the property value, okay? And based on that, and what has happened historically, you're able to have a pretty good model of, if I execute well, my business will grow by X, right? So that's when I started investing in multiple deals so I can look at how they operate. I also flew out with my partners to go check out their properties. So I was doing due diligence with them. I was walking in the property, walking in each unit before purchase to make sure to see what conditions they're in. I started meeting property managers. I started meeting brokers. So I was passive about 2 years. And then because I already had a pretty good network of people, you know, from my interactions, and so I knew I was pretty much ready, and you know, that's when I started looking for deals. So why did I switch from passive to active role? I guess because I'm a hands-on guy. I like to get involved. I want to, and I just know so much about the business, and I know this, you know, what needs to be done, what to do. So, and another thing is I like pain. Okay, you have to really like pain to be an active investor because it's a lot of work, right? So take, for example, when I search for a property, it may take me up to a year looking at, over 100 deals to come and find one that really makes sense for me and other investors to invest in, right? But that's a year of searching, okay? So after you acquire the property, the sponsors, who is me, is gonna be the one that's running the property for the next 5 years. So I'm actively running these properties. I have a conference call with them every week. We're following all the progress extremely closely, pretty much on a daily basis, right? So it's a certain level of time commitment as well. So, but I enjoy it. I just really like it. I think, yeah, so I really do enjoy it. Do I still play the passive investor role? Yes, I do, actually. So in fact, I just invested in another deal last year. This year's deal flow is there's not as many deals going on because of COVID, but what I was able to leverage is using my retirement funds. So what you can actually do is with your rollover IRA or any IRA that you have, this IRA can actually be converted into what's called a self-directed IRA, where you're able to actually invest in not just stocks, you're actually able to invest in apartment deals. You're able to invest in startup funds, okay? Your options for what to invest in increases greatly when you convert it to a self-directed IRA. So, I started leveraging that, diversifying my retirement investment. So, yeah, and that allowed me to, invest in even more deals. So those are great. Okay. So Aziz asked, how's the apartment market in Dallas in the COVID era? It's actually doing surprisingly well, right? So I think I mentioned this in the last call, also at the beginning of this call. Occupancy, I think we saw maybe a 2 to 3% drop, not much. Collections, okay. Collections, we're pretty much, 93, 94% of what it was before the shutdown. And bear in mind that we're prohibited from charging late fees, and late fees is usually 3%. So in effect, we're only dropped about 4 to 5% in rent collections. So yeah, apartment has been really good. And that also means that the prices for for apartments that we can buy did not drop that much. Okay. Some sponsors now only investments through funds that cover multiple properties. What are your thoughts? Okay, so what Nilesh is referring to here is most of the time you invest in a single property, okay? So that's a benefit of investing in apartments. You know exactly which property you're investing in, which area it is, which submarket, what type of property, all that kind of stuff. And you can evaluate for yourself, do I want to be in this deal or do I want to be in the next one, right? And then there are things called blind funds, okay? So blind fund is where a group of people set up a fund, okay? And this fund could be like a $8 million fund. And you set this up at the beginning of the year. And then you would go and then look for properties to buy, okay? And then in that year, maybe you acquire 2 to 3 or maybe 4 properties using the money from the fund, okay, to do that. So that's called blind fund because you don't know what you're investing in. You're basically trusting the sponsor to find good apartments to put into this fund. Okay, I'm also involved in one of those deals, in a blind fund deal. So like I said, I invested in a little bit of everything. I want to increase my exposure. So blind fund is, in my opinion, not great. The reason is I don't know what property I'm buying. I don't know if they are buying at a if they spend too much. I can't decide that. Okay, I can't decide if their projection are for how much they think they can charge in rent is not reasonable. I don't have control over that. You have to have complete trust of the guy or girl leading the project, right? So another problem with blind fund is you put your money in at beginning of the year, but they may not acquire property until middle of the year or late in the year. That means for a period of time, your money is actually sitting there, not earning anything. It's just sitting idle. So, I prefer not to invest in blind funds for that reason. The sponsors do it because they want to make better use of their time. They're basically lazy. They don't want to have to go and raise money every single time they get an apartment. Okay, they just want to get a lot of money and then they'll just go and acquire, right? Because getting investments takes money. Takes time. Takes time to talk to people, takes time to set up presentations. So it's much more efficient if it's just in a blind fund and then they can go acquire. But if a person is very reputable and has been really successful, maybe I'll do that. But because I'm pretty good at evaluating deals, so I rather evaluate deals that I know has a pretty good chance of being successful. So, and there's no reason to only require people to invest in that style. There's other sponsors as well. You don't always have to go with that sponsor. Okay. Next question. From the perspective of liability of property owners to tenant, is there a difference between passive and active investors? Okay, so liability. Yeah, great question. So when we go and acquire these properties, what we do is we set up an LLC, and that LLC would be the owner of this apartment. And everybody who invests in the deal owns a portion of that LLC. Does that make sense? So so what this does is it protects everybody from any lawsuits. Okay, so if somebody slips and falls, we have insurance coverage for that. But let's just say something really bad happens, right? And somebody wants to sue the apartment for way more than what we're covered for. They can only sue the LLC. They cannot come after you. Okay, so for these investments, what you're putting at risk is your original investment only. So let's say you put $50,000 into the investment. Well, the most you'll ever lose is $50,000. You'll never be hit with a lawsuit that comes after you and comes after your personal asset because it's all protected by LLC. Okay, so that's the way it's set up. But furthermore, it doesn't ever get to that point because on the properties that I buy, not only do I go for maximum coverage on the dwelling, which covers fire, wind, hail, those kind of stuff, we also bought a $5 million umbrella policy for the apartment. So if anybody really slips and falls and sues us, we're covered by the umbrella policy as well. So, in this world, there's a lot of investments you can make, and each one comes with their own risk, right? So what we do is on the apartment side, we're actually able to pretty effectively, I wouldn't say eliminate, but mitigate almost all the major risks. So yeah, so as a passive, you really don't have any risk. You basically invest the money and you collect checks. That's really what happens. For the active sponsors, there's a little bit more risk. Okay, so when you apply for a loan, only the active sponsors, the leads, are on the loan, have to be on the loan and be liable for the loan. Okay, the passive investors do not have to be on the loan, so they don't share any risk. Okay, so so when we take out a loan for $10 million, for example, the combined assets of all of our partners have to add up to be at least the value of the loan. So if we take out a $10 million loan, our combined asset actually needs to be at least $11 million. Okay, not all sponsors can do that. So sometimes they find somebody who has a very high net worth and invite them to be part of a team to help qualify for the loan. But the risk is really on the sponsor side. And then for that, what we do is we go for Fannie Mae loans. So Fannie Mae loans are non-recourse loans, which means that if the property was ever defaulted on or sold for less than a loan value, they cannot come after the partners for the difference. So it's a non-recourse. If you go to small banks like Wells Fargo, Chase, or whatever, those are full recourse loans. So if you bought a property for 10 million and then you had to short sell it for 8 million, you're on the hook for $2 million. But that only impacts the sponsors, not the passives. The passives are very protected. Okay. Yeah, I like the idea of walking local properties. I find myself eyeballing every apartment building I drive. Yeah, so yeah, I actually found that to be true. Before I actually never really noticed we had that many apartments in the Bay Area, but once you start paying attention, it's like we have apartments up and down Sunnyvale, in Mountain View. There's just like tons and tons of them, and But what we see in Texas is they have much larger apartment complexes. So over there, you easily get 2 to 3 to 400 unit sized apartments. Yeah. Do you need to pay tax for the returns gained through SD IRA? Yeah. Okay. And is this income tax or capital gains tax? So it's a mixed answer, but the first answer I'll give you is no, you don't have to pay tax because it is in a tax sheltered account. Okay, so any earnings that you make from self-directed IRA goes back directly into your IRA account. Okay, however, to keep things fair, the IRS has implemented something called UBIT, okay, UBIT. So basically, if people are using retirement funds and getting a loan to invest in a deal, that's not really fair to somebody who's using after-tax money to invest, right? So they have this UBIT formula to make sure that the playing field is even. So no, you don't have to pay any income tax, but you do have to pay this UBIT tax, okay? Now, this UBIT tax probably will run you, I don't want to say because it's different for every deal, but you're probably looking at, a few $100 or, a couple $1,000 in that range. If you have a $100,000 investment and you got like $100,000 back, right? So you doubled your money, you're probably liable for, in the order of about $1,000 of tax that you had to pay, right? But that's really nothing. That's really nothing in the grand scheme of things. So, so that's a benefit, right? You don't have to pay tax, right? But apartment investments are so tax efficient that they're actually really good to reduce your to reduce your normal reporting income. So if you one of the drawback of investing in using IRA is you lose some of these great tax benefits, right? Because it's already tax sheltered. Yeah. Okay. So did you go visit the passive investments you get involved in? The first few, pretty much the first few I did, okay? The first few I did, And then I would say for like the other ones, because I go to Dallas about once a month, so I would drop by. I'm pretty familiar with all the areas. So for my investments in Dallas, I already know the areas, and I actually go and drop by most of them on my trips. So I do I do visit, but places like my self-storage deal in Wisconsin, I didn't go. You know, I was looking at the market comparisons, and I already got a pretty good idea. So, and the LA one, the plumbing company, the commercial size plumbing company, I didn't go visit that. And it wasn't my interest to look at plumbing lines, but I flew into a lot of places. I went to Las Vegas. I went to Las Vegas to look at a deal next to UNLV. It was a student housing deal. And I flew out to a lot of places just to check out the deals and, you know, see how things operate differently. So, yeah. Have I considered doing solo 401k? Yes. In fact, I have both. I have a self-directed IRA as well as a solo 401k. So for those of you that are not familiar, your IRA can be converted into these two investment options, right? One is self-directed IRA, one is solo 401k. They both have their pros and cons, right? So solo 401k, you don't have to pay the UBIT tax, okay? But solo 401k requires that you have a business. You have a business that's generating income that can, that will require a 401k. So unless you have a side business where you're already generating, you know, significant income, I would say like you should be generating at least $3,000 to $4,000 of income a year. Then you probably will qualify to set up a solo 401k. But if you don't have this other income, business income, then it's much safer and much easier to just set up a self-directed IRA. And sponsors would take both kind. Yeah, they would definitely take both kind. It is more work for the sponsors because depositing the cash into these accounts, I had tremendous trouble. I had tremendous trouble with Fidelity and Chase when trying to deposit into these type of accounts. And we end up having to send checks for those people. So it's extra paperwork for the sponsors, but usually sponsors will take it. Yeah. So now you ask, aren't passive income investments considered passive? Yeah, passive investments are passive income, in which case you cannot benefit for the loss immediately. Okay, so yes. So your normal income is categorized in a few categories, right? So you have your ordinary income, which is your W-2, you know, your 1099, well, your 1099 would be your business, but, you know, you could have your business income. You could also have capital gains income. And another category is passive income, okay? So apartments and other rental, you know, these kind of things, they're considered passive income, meaning the gains and losses that you get, you don't get to deduct anything against your, you don't get to deduct them against your ordinary income. Okay, but it is still a flow-through entity in which the LLCs, your ownership of the LLC, that income flows through to you, to your personal income tax, right? So, you know, it works great for some people who have rentals that they already own. They have rental income. They can use that passive loss to write off their other rental income. Okay, so that would be really good. And sometimes, you know, if you invest in some of these deals, it's staggered. So if you have a passive loss that's carrying over, and then one of your deals sells, those losses can immediately be used to offset the income there, right? So that's a good thing. So in general, let's say we hold the property for 5 years, right? Because we can claim immediate depreciation loss on these large properties, let's say you invested $100,000 and the cash flow is 8%. That means you got $8,000 in your bank, but you don't have to pay any tax on it because of the depreciation loss on paper. So when we send out partnership K1s to people, for the first few years, they basically don't have to show, they don't have to pay tax on any income because they had a income of $8,000, but a paper loss of 50 grand, for example. And that pretty much means that your first few years of cash flow are all tax deferred. You don't have to pay tax on them. And you can free up those money that you didn't pay tax on to do other investments. And that's how we snowball the money. Okay. You mentioned that you observe 3 to 5% discount on multifamily markets. Now, do I see this going up or going down? So it's really hard to say, yeah, because like you said, we want to see how August and September pans out, okay? But right now, the kind of deals that are coming back are the deals that didn't get sold in the beginning of the year, right? And they're still pricing it pretty aggressively, okay? And instead of dropping prices, they're also trying to do other things, like we will guarantee the rent income for the next 4 months to be at the same level as you bought it at, okay? To make you feel, to make sure that you don't get hit by COVID and have some rental losses, right? So they're trying these different things, or we will help finance some of your escrow, okay? So they're doing other things to avoid having to drop the prices too much. And that's how some of the deals are getting done. It's being much more creative. So in the short term, this 3 to 5% discount is based more on lender requirements, not market condition. Okay, it's a fact that you had to put up much more money for the same investment. That's what's causing the returns to drop, right? So if the lenders feel safe and then they let go of all restrictions or like no escrow requirements, I wouldn't expect any discount at all, so yeah. But if the stimulus package dries up and then people lose their jobs and then they're not getting income, they're not paying their rent, then yeah, the prices will come down definitely, because the price is based on income, right? So if the income drops by 10%, guess what? The asset just become 10% cheaper, right? So. Okay. Anybody else have any questions you want to ask? Okay, great. So last minute housekeeping. So for our next meetup conversation, I actually invited somebody really cool. So in this downturn, we're all looking for ways to save money. So one of the largest expense that we have is actually on utilities, right? On electricity, on water, all this kind of stuff. So I actually know a nationwide broker on electricity rates. Trust me, I know far too much about electricity, about gas generation, about the current EPCOT pricing. I know much more than you would ever want to know. But anyways, I invited him to come and give us a presentation on, how is electricity, how is utility calculated, what are the current trends, is the pricing going up and down? You know, is it getting more expensive because more people are using electricity now? All these kind of stuff, right? So, and also right now we're trying to see if we can refinance for a lower rate, a lower electricity rate, and that would just, you know, lower our expenses, right? So that being one of the largest expense, and we're all trying to cut down our expense. I thought it would be a really good topic. So I invited him to come and speak, and we'll probably set up our next meetup for end of the month. So yeah, I think I'm looking forward to bring guest speakers from different aspects of the field, and you know, so everybody can learn more from it. Okay. Cool. Thanks, everybody. So look forward to you know, seeing everybody again on the next meetup. I'll send up an invite like tomorrow. So yeah, be sure to join us again.
Hey, thanks, Tony. Great.
Yeah.
Thanks, Tony.
Sure, definitely. And yeah, if you guys have any questions, feel free to, you know, reach me offline.
Thanks very much, Tony.
Yeah. Okay. See you guys later.